Good morning, ladies and gentlemen. Today's topic is the income statement for our Gr10s. We'll be looking at that. Remember, on the 13th, we did the adjustments, and from the adjustments, we did the two final accounts, trading account and the profit and loss account. Now, today we'll be looking at the income statement. Remember, I told you that those are the build up to the income statement. Now, without any waste of time, let's quickly look at our question. Our question 1. It says there, as Masiza owns a shop called Gr10 that sells soccer kit items. Gr10's financial year end is 28 February 2019. Very important that we are able to identify when is the beginning of our financial year and then when is the end of our financial year. If the end of our financial year is 28 February, it means the beginning will be a day after this one, which is 1 March 2018. Very important. Now let's go back to our question. It says that you are required to draw the income statement for the year ended 28 February 2019 from the given information below. Note, all adjustments figures must be shown in brackets next to the account. The business uses a markup policy of 50%, which has been strictly adhered to. Right. Now, the markup percentage of 50 cents. Very important that we know if our markup percent is 50%. It means our selling price is 150 because the cost price is 100%. Very important that you know this that we draw this table. This table will assist us either to calculate selling price, which is sales, or cost price, which is cost of sales. Now, markup it is the percentage of profit that the company is adding towards their items that they are selling. Right. Now let's go back to our question now. Here we have general ledger of Gr10. It is profit and loss account, final account section. Right. Remember, last week I said to you that on the debit side of your profit and loss account are your expenses, and then on the credit side of your profit and loss account are your incomes. Now, and then we balance, we close off our profit and loss account using trading, using capital account, right? And then this trading account of 98,500 comes from the trading account T account name. So it was transferred to the credit side of your profit and loss account. Right. Now let us look at the adjustments. Very important that as we approach our income statement, we approach our income statement in this fashion. Right. The first part, sales minus cost of sales, and then you get a gross profit. It's part A. And then part B will be other income. And then part C will be other operating expenses, and then part B will be this part here after operating profit for the year up until net profit for the year. Right. Now let's go back to our question. Let's read there. It says that the bookkeeper has made an error in calculating the profit in the profit and loss account. This needs to be corrected by taking into account the following information. We are correcting the profit and loss account. We are correcting the profit and loss account, but at the same time, we are doing the income statement. We are doing the income statement, correcting our profit and loss account. Remember, I said to you, the profit and loss account, we prepare our profit and loss account using the nominal section. Within nominal section, we have expenses that will be on the debit side, and then incomes that will be on the credit side. Now, let's go to our question. The question says adjustment and additional information. Right. Number one says that the rent amount was actually for rent received from one of soccer supporter who rents part of the shop where he sells helmets, sirens, including vuvuzelas, and other items used by supporters in the stadium for entertainment. Right, now let's go back to our question. Profit and loss account, look there. That 13,000, it is on the debit side of the profit and loss account, meaning it was treated as if it is an expense. Remember, we are correcting, and then the adjustment is very clear to say the rent amount was actually for rent received from one of soccer supporter who rents part of the shop. So now it is actually rent income, not rent expense. In other words, it was supposed to be credited on our profit and loss account. Remember, our question, we are correcting that using compiling the income statement. So now ours will be just to record here under other operating income, rent income, right? 13,000. Right. Now let's go back to our question. Second, at number 2, the debtors allowances have not been treated correctly. Debtors allowances have not been treated correctly. Now let's go check our debtors allowances. Here's our debtors allowances, 530. Remember, 530 debtors allowances decreases most our sales. Am I right? Right. Now, in our here it was treated as an expense. It was recorded on the debit side of our profit and loss account. Now let's look at our income statement. How are we supposed to record that? Under sales here, remember, debtors allowances are the returns we have received from our debtors. Now, returns received from our debtors decreases our sales. Right. Let's go back to our question. Take adjustment number 3. It says that on the 18th February 2019, Debtors had a break-in and trading stock to the value of 4,750 was stolen. No entries have been made to record this, and as as the business is not insured, they cannot claim for this loss. Now, the 4,750 worth of stock was stolen and there was no insurance, so that will be treated here under operating expenses as stock lost due to theft, and then we'll just say open bracket plus 5,750. Let me check. No, 4,750 stock loss due to theft. 4,750. Let me check. Yes. Right. Now, adjustment number 4 says that the advertising account had been overstated by 150. Now, when the word overstated, it means it was more with 150. Now, in our let's check the advertising. There's the advertising, 4,550. Remember, advertising is an expense. It has to fall here under operating expenses. We'll write here advertising. Right? And then open bracket, advertising 4,550. So we'll write here 4,550 minus 150. Right. Then we go to the next question. The next question there, adjustment number 5 says that the business has loan of 20,000 at ZK Bank for the half the financial year. Interest has been paid monthly at an interest rate of 12% per annum, but the bookkeeper had allocated the interest to the loan. ZK Bank account correct this error. Right. Now, remember, in our on our face of income statement, interest expense comes here just after we have after we have added the interest income. So it comes here, interest expense. Now we must calculate the interest name. Remember, they said to us that interest has been paid monthly at an interest rate of 12% per annum. Right now, the first line says that the business has loan of 20,000 at ZK Bank for the half the financial year. Right. The loan was taken, but only for the half of the financial year. Right, and then the interest rate is 12% per annum, 12% for the whole year, meaning we did have the 20,000 loan from the bank at 12%, but this 12% is for the whole year, right? We want for 6 months, for half a year, right? So now you're supposed to say 20,000 times 12% divided by 100 times 6 divided by 12. What is our interest that needs to be paid? Will be 1,200. It will be 20,000 here times 12 divided by 100 times 6 divided by 12, and then we get 1,200. Remember, it is an expense. You put it inside the brackets. Right. Now let's go to the next adjustment. An invoice for stock sold for 4,500 has not been entered. make necessary entry. An invoice, it means goods were sold on credit, right? Now, this invoice was not recorded, right? Now we go back to our remember this this invoice is 4,500 rand. That is the sales name. The amount that the sales our sales is supposed to increase with. But at the same time, this was not recorded. So now we're supposed to calculate the cost of sales for of that 4,500 so that we can also add that to our cost of sales. Remember, when we buy, our cost of sales increases. When we sell, our cost of sales decreases. Right. Now, let us work that 4,500 out. That is why we were given the markup name. The markup, remember, they said is 50%. And then if our markup is 50%, it means our selling price is 150 because the cost price is always 100%. Now, we have now 4,500 rand. 4,500 rand is our selling price. It is our sales, right? Now, we want to calculate the cost price. Cost price is cost of sales. So now you'll say amount times what you want divided by what you have. 4,500 includes most the markup percentage of 50%. So that is why we're putting it next to this selling price 150%. But what we need to calculate is cost price. So we'll say 4,500 times 100 divided by 150. You'll get 3,000. 4,500 times 100 is what we want, divided by 150. That is 3,000 rand. This 3,000 rand is cost of sales. Now, let's go back to our income statement. Now, remember, this transaction was not recorded at all. Now, we need to add here 4,500 rand. We need to add 4,500 rand. And then on our cost of sales, we must add the cost of sales of 3,000 rand. Right. Go back to our adjustments. Adjustment number 7 says here, the following problems were encountered with debtors at the end of the financial year. A debtor S. James was declared insolvent. When a debtor is declared insolvent, it means he or she is no longer able to pay his or her debt, right? His estate paid 90 rands, being 20 cents in the rent. The receipt has been recorded, but no entry for the amount to be written off has been recorded in the books of the business, right? Now, immediately, when we write off a debtor, our bad debt is supposed to increase. Now, let's go back to our profit and loss account. We do have bad debts here, yes. Bad debt, 300 rand. So now here, we'll have bad debts, open bracket, 300 rand. Right. This 300 rand comes from the profit and loss account. But remember what the estate of S. James said to us. They said to us that they paid 90 rands, being the 20 cents in the rent. So in other words, the business out of one rent that S. James is owing to it, they've only received 90 rents, right? Which is 20 cents in one or each and every one rent that S. James is owing to the business. Now, we must now calculate what we need to write off. In one rent, we have received 80 cents. In one rent, we have received 20 cents, sorry. Now, we must write off how much? 80 cents, right? 80 cents is what we need, and then what we have is 20 cents. They said so. They said 90 rand is received, and that is 20 cents of each and every rent that he was owing to the business. So now we'll be saying amount times what we want is 80 cents, divided by what we have is 20 cents. Now, let us check how much must we write off now. Times 80% divided by 20 cents. We need to write off 360. We need to write off 360. So our bad debts will increase by 360. All right. Right. Let's go back to our adjustment. We go to adjustment number 8. The bookkeeper recorded 400 rand received from a debtor whose account was previously written off. The bookkeeper received 400 rand from a debtor whose account was previously written off by debiting the bank and crediting the bad debts. Correct the error. Meaning what happened is this is the account that was previously written off. Now, if the account was previously written off and then that particular debtor came back and pay us, we're supposed to debit a bank name, and then because our bank will increase, and then credit bad debts recovered, because that will serve as an income to the business. Incomes are always credited, expenses are always debited. Bank increases on the debit side, hence it is debited there, right? But the mistake that the bookkeeper did here, she credited bad debts when she was supposed to have credited bad debts recovered. Now, we need to correct that error. Let's go back to our provident loss account. Here we have bad debts recovered. It is 130. It means now bad debt recovered, remember I said to you, it is an income. Hence, on our provident loss account, it is recorded on the credit side. The recording there is correct. What is not correct is for the bookkeeper to credit the bad debts. Meaning that's what we must correct, but on the face of our income statement. On the income statement here we'll write here bad debts recovered. Amount there is 130, and then now we look how much you have received, right? how much we have received from this debtor. We have received 400 rand. We have received. So here we will add 400 rand, and then on our bad debt account, look there, we have 300 rand plus 360, and then we need to add back this 400 rand that that the bookkeeper subtracted in error. Right. Let's go back to our trial balance. I mean, profit and loss account. We have adjustment number 9. Adjustment number 9 says here, a stock take was done after the profit and loss account was drawn up. It revealed that trading stock to the value of 1,000 was unaccounted for or missing, and there was still packing material costing 450 that has been used. Now, here we have a transaction where a stock taking was done, and then after the stock taking was done, stock to the value of 1,000 was unaccounted for or went missing. Let us deal with that one first. Stock unaccounted for or went missing. In our income statement, remember we have stock loss due to theft. We'll add that 1,000 there. We'll add that 1,000 there. Then we go back to the second part now. It says here, and there was still packing material costing 450 that has been used. Right. We go back to our let's go back to our profit and loss account. The profit and loss account is here, right. Packing material is 2,060. That is the total of our the value of our packing materials, right? And then the adjustment says here that we have used packing material to the value of 450,000. 450. Right. There was still packing material costing 450 that has been used. Right. Let's go back to our income statement. We'll write here packing material. No, packing material 2,060. Right. We subtract 450. Right. 2,060 minus 450. We are left with 1,610. Now let me correct this adjustment. I think here, because this stock taking was done, I think it was error here. It is supposed to be there was still packing material costing 450 that has not been used, meaning we'll be having a total here of 2,060 worth of packing material, and then we'll subtract this, what has not been used, and then the balance on our income statement will be an expense, right? So, sorry for that error there. Right, let's move to adjustment number 10. It says a telephone account for March 2019 has been received and paid in advance for 1,450. Telephone account for March 2019 has been used, has been received and paid in advance, 1,450. Now let's go back to our profit and loss account. Check there if we have a telephone. All right. Let's go to our, we don't have it here as part of our expenses. Let's go to our income statement. We have telephone here, 6,700. It is the balance, but now it says, remember our adjustment says here, this 1,450 was paid in advance. Any expense that is paid in advance by the business is prepaid expense. Prepaid expense, we subtract. So now it means that here on the face of our income statement, we'll subtract 1,450 because it is prepaid expense. Prepaid expense, we subtract. Accrued expense, we add. All right. Now let's go to our adjustment number 11. It says here, provide for depreciation of 23,800 for the year. Depreciation, remember, we have assets in the business that at the end of each and every financial year, we must calculate the depreciation that will decrease the value of our fixed assets. Now, this depreciation, it is an expense. It has to be recorded under operating expenses. Now here, we'll record here depreciation, right? And then how much is the amount? The amount is 23,800 rand, right? It has already been calculated for us, unlike when we are doing the final accounts, where we remember we had to calculate the depreciation using both methods, on cost as well as on diminishing balance method. Right. Adjustment number 12 says here, the bank statement received on the 28th February revealed the following: bank charges to the value of 285. Now, bank charges are supposed to form part of our operating expenses on the face of our income statement. So here we'll write here bank charges, right? And then it's how much? 285. 285, right? Now once we have dealt with all our adjustment, like here we did adjustment number 1 up until adjustment number 12. We must now go back to our profit and loss account. Look for for the accounts or figures that we did not deal with using the adjustments. Now I will start with the credit side of our profit and loss account. Discount received. We did not say anything about it, therefore we have to record that on the face of our income statement under other operating income. Here we'll write discount received. And then it is how much? 340. Bad debts recovered, we have already dealt with. Interest on investment. Interest on investment, it is interest income. We did not have any adjustment for it. Therefore, we must take it as it is to the face of our income, to the face of our income statement. Just underneath operating profit for the year, we'll have interest income. We'll have interest income to the value of 900. There's an income. It has to stay. It has to be positive. We don't put it inside brackets. Any expense, only expense that we must put the brackets with them. Then we go back to our profit and loss account. We check which accounts here. Now that we are done with the credit side, we'll check the debit side. The debit side, the first one here we have salaries and wages. We did not say anything about salaries and wages, so we take the amount as it is to the face of our income statement. Let's check. The amount there is 34,690. 34,690. And then we go back. Let's go back. Pension contributions. We did not say anything regarding. We don't have any adjustment regarding pension contributions. So we take them. We take the amount as it is to the face of our income statement. 4,300 rand. Let's go back to our profit and loss account. Medical contributions of 1,870. We did not have any adjustment regarding it. Therefore, we take 1,870 as it is to the face of our income statement. 1,870. Right? Then let's go back. And then it's sundry expenses again. We did not have any adjustment regarding it. Therefore, we must take the amount as it is to the face of our income statement. 12,120. Right. And then packing material, we had it. Ours will be just to close the bracket. Close the bracket. We have 2,060 minus 440. We have 1,610. Right. 1,610. 1,610. Right. let's go back to our profit and loss account. Bad debts, yes, we did have an adjustment with it. Ours now will be just to close off now. So now it will be 300 rand plus 360 plus 400 rand. So it's 1,060. 1,060. Right. And then discount allowed, we did not have anything for it, therefore put it here. Discount allowed. $20, right. Then let's go back to our profit and loss account. Debtors allowances. Remember, debtors allowances decreases our sales account. Therefore, we must close off the bracket. It will be 295,500 minus 530 plus 4,500. You get 299,470. Right. Right. And then we go to the next one. Advertising. Advertising we did. You go there, close the bracket. It will be 4,550 minus 150. It will give you 4,400 rand. 4,400 rand. And then the last one is trading license. We did not have any adjustment for it. Therefore, we take it as it is to the face of our income statement, and then we write the trading license, and then it is how much? 1,800 rand. Is 1,800 rand, right? It's 1,800 rand. And then the next one is rent. Remember this rent, it was that rent that was wrongly recorded. It is rent income. Let's go back to our income statement and then check it. It's here, right? Here we can just close off our bad debts recovered. 130 plus 400, it is 530, right? And then the next one would be capital. Capital, remember I said to you, on the income statement, we only draw the income statement using profit, using nominal section accounts, which is incomes on the credit side and then expenses on the debit side. So capital, you never get any capital account there under nominal section account. So that one, you leave it. You don't include in our profit and loss account. Now let us close off our income statement. Then let's close off our income statement. Let's close off our income statement. 197,000 plus 3,000, it will give you 200,000. Right? This is an expense. I get it. You subtract the 200,000 from the 299,470 to get your gross profit, which is 99,470, right? And then you add your operating income. Your operating income is 13,000 plus 530 plus 340. The total would be 13,870. Then you add these two amounts here. 99,470 plus 13,870 to get or to arrive at a gross operating income. So now you say 99,470 plus 13,870, it is 113,340, right? And then you must add all your expenses. You must add all your operating expenses. Right. Let's add all our operating expenses. It means now you'll say 34,690 plus 4,300 plus 1,870 plus 12,120 plus 5,250 plus 4,850 plus 4,400 plus 1,060 plus 1,610 plus 23,800 plus 285 plus 1,820 and then your total for operating expenses is 96,055. 96,055. Remember, this is the total of your expenses. You put it inside the bracket name. And then you'll then say 113,340 minus 96,055. You get your operating profit of 17,285. 17,285, and then you add your interest income of 900 to get your 18,185. And then you subtract interest expense of 1,200 to get the net profit for the year, which is 16,985. That is our income statement, ladies and gentlemen. As we wrap up, yes, we do not have any adjustments like we did when we were doing the final accounts. But I will just quickly remind you that in the on the face of the income statement, when you get the adjustment, you analyze your adjustment and be able to arrive as to whether the adjustment is prepaid, or accrued expense. Now, what is the difference between the two? Prepaid expense, the sign is negative on the face of our income statement. Accrued expense, the sign is positive on the face of our income statement. Now, any expense that is prepaid, and or overlaps in the next financial year, that will be prepaid expense. We subtract. In expense that we are still owing at the end of the financial year, it is accrued expense we add. Now, I said to be able to analyze if you have an adjustment of an income be able to arrive as to whether it is accrued income or income received in advance. Accrued income, we add. Income received in advance, we subtract. Now, how do we know the difference between the two? Any income that we are still owing, or that we still have to receive, that is still receivable at the end of the financial year, will be called or will be regarded as accrued income. And then we add. Any income that at the end of the financial year, the tenant or the client pays to us for the next financial year, we call it income received in advance. We subtract. These signs are very important, especially on the face of our income statement. Ladies and gentlemen, we have come to the end of our fruitful session for our grade 10s. I hope you have learned something for the day, and I'll keep on coming and updating you. Let us meet on Wednesday for grade 12s. VAT and we'll be doing VAT and budget for our grade 12s. Thank you very much. Take care of yourself, and we'll meet next time. Thank you very much.